Today, there is a huge difference between what the financial headlines are saying and what the bond market is actually signaling. If you watch most economic news, you'll hear discussions about moderate growth, persistent inflation, and possible interest rate adjustments. Many analysts still talk about economic resilience, the ability of companies to continue growing, and the strength of consumption. But there is one market that tends to observe the economy in a much colder and more strategic way. That market is the bond market. Throughout my career analyzing financial cycles, one thing has become very clear. When the bond market starts sending consistent signals about the future of the economy, it's worth paying close attention because this is not a market dominated by enthusiasm or short-term narratives. It is dominated by extremely sophisticated institutional investors. We are talking about large pension funds, global insurance companies, central banks, and asset managers who administer billions, sometimes trillions of dollars. These institutions cannot afford to make decisions based on momentary optimism or pessimism. They need to deeply understand what might happen to the economy in the coming years. And that's precisely why the behavior of the bond market often anticipates important economic changes. Before several historic recessions, the first signs appeared precisely in this market. Bond prices began to change, yields began to adjust, the structure of the yield curve began to send warnings, and most of the time, these signs appeared long before the economic slowdown became evident in official data. Now, pay attention to what's happening right now. When we carefully analyze the current behavior of the bond market, we notice a pattern that is beginning to catch the attention of some of the world's most experienced investors. There is a growing perception of risk on the horizon. More specifically, the market seems to be pricing in the possibility of a significant economic slowdown around 2026. And here's the curious point. While the bond market is beginning to reflect this type of concern, much of the economic debate remains focused solely on the present. Many analysts continue to discuss current data, quarterly figures, and short-term projections, but the bond market doesn't work that way. It always tries to answer a much deeper question. What will the economy be like in 2, 3, or even 5 years? And when such a sophisticated market begins to adjust its prices around a possible future scenario, ignoring that movement can be an extremely costly mistake. Therefore, the central question we will explore in this video is, what exactly is the bond market seeing now that most people haven't yet noticed? And perhaps even more importantly, if this market is correct once again, what could that mean for the global economy in the coming years? To understand why these signals are so important, we first need to understand something fundamental about the structure of the global financial system. There is a clear difference between how the stock market works and how the bond market works. The stock market is often dominated by narratives. It reacts to cycles of enthusiasm, technological innovation, quarterly results, and often speculative movements. It's not uncommon to see stocks rise or fall rapidly based on expectations that can change in a matter of weeks. The bond market, on the other hand, operates with a very different logic. When an investor buys a 10, 20, or 30-year bond, they are essentially making a deep assessment of the future of the economy. They need to consider variables such as long-term economic growth, structural inflation, government fiscal stability, and the monetary policy that may prevail over several years. This means that participants in this market need to think in much longer time horizons. And who are these participants? For the most part, we're talking about gigantic institutions, pension funds that need to guarantee retirements for decades, insurance companies that manage enormous financial reserves, and central banks that directly influence the liquidity of the global system. These institutions cannot make impulsive decisions. They rely on complex models, detailed macroeconomic analyses, and rigorous risk assessments. That's why many experienced investors often say that the bond market functions as a kind of early warning system for the economy. Over the past few decades, we've seen this pattern repeat itself several times. Before the recession of the early 2000s, the bond market had already begun to reflect concerns about an economic slowdown. Institutional investors were reducing risk exposure and adjusting their portfolios before most analysts noticed the shift in the cycle. The same thing happened before the 2008 global financial crisis. Long before the collapse of the financial system became evident, Some signs were already emerging in the credit markets and in the structure of bond yields. Even in more recent episodes of economic slowdown, we observe something similar. Bond market movements often begin quietly, almost imperceptible, to those looking only at headlines or superficial indicators. But for those closely following these movements, they can reveal profound changes in risk perception within the financial system. And that's precisely what makes the current moment so interesting. When we analyze bond prices and yields today, we realize that something is gradually changing in how large investors are assessing the future of the economy. We're not talking about panic, we're not seeing extreme movements yet, but we are observing subtle adjustments, and historically, it is precisely these initial adjustments that often precede much larger changes in the economic cycle. To understand exactly what the most important signal the bond market is sending now is, we need to look at a specific indicator that Wall Street follows very closely. This indicator is known as the yield curve. Throughout modern economic history, it has been one of the most reliable instruments for anticipating periods of slowdown. Now we need to talk about one of the indicators most closely watched by institutional investors worldwide, the yield curve. If you want to understand how the bond market attempts to anticipate the future of the economy, this is probably the first place you should look. The yield curve, in simple terms, represents the returns on government bonds at different maturities. For example, we can see how much the market pays to lend money to the government for 3 months, 2 years, 10 years, or even 30 years. Under normal economic conditions, this structure follows a fairly clear logic. The longer the loan term, the higher the yield demanded by investors tends to be. This happens because risk increases over time. The longer the period, the greater the uncertainty about factors such as inflation, economic growth, and financial stability. Therefore, in a healthy economic environment, the yield curve typically has a positive slope. Long-term bonds pay more than short-term bonds. But when the market begins to see risks on the horizon, something very interesting starts to happen. The structure of the yield curve can invert. This means that short-term yields become higher than long-term yields. At first glance, this may seem strange. Why would anyone accept lower interest on a longer-term loan? The answer lies in expectations about the future of the economy. When investors begin to believe that an economic slowdown is approaching, they also begin to expect that central banks will eventually lower interest rates to stimulate the economy. Faced with this expectation, many investors rush to buy long-term bonds before yields fall. This movement increases the demand for these bonds and, as a result, their yields begin to fall. At the same time, short-term bonds continue to reflect current monetary policy rates, which may remain elevated. This combination creates a phenomenon known as an inverted yield curve. Historically, this has been one of the most consistent warning signs within the financial system. Before virtually every modern recession in the United States and several other developed economies, the yield curve has undergone some degree of inversion. This doesn't mean that a recession happens immediately. In fact, there is often a time lag between the inversion of the curve and the actual economic slowdown. This lag can last several months or even a few years. But what makes this indicator so relevant is the fact that it reflects the collective view of extremely informed institutional investors. We are not talking about isolated opinions. We're talking about trillions of dollars being positioned based on expectations about the future of the economy. And right now, when we analyze the current yield curve, we see something that deserves attention. We are facing one of the deepest inversions seen in recent decades. For some experienced investors, this raises an inevitable question. If the yield curve historically anticipates changes in the economic cycle, is the bond market once again trying to warn us about what might happen in the coming years? To answer this question, we need to look at another important aspect, the mistake many analysts make in interpreting the current state of the economy. After understanding the role of the yield curve, we need to discuss a very common error that appears repeatedly in economic debate. Most analysts observe the economy primarily by looking at the present. They analyze recent data such as GDP growth, employment levels, household consumption, and corporate earnings. When these indicators appear relatively stable, the conclusion is usually that the economy remains healthy. This type of analysis seems logical at first glance. But there is a fundamental problem with this reasoning. Economic cycles rarely change abruptly in traditional indicators. Most of the time, official data reflect what has already happened, not necessarily what is about to happen. There is always a lag between the moment when financial conditions begin to change and the moment when these changes clearly appear in macroeconomic data. And it is precisely within this time frame that the bond market typically operates. While many analysts are still assessing current economic figures, institutional investors are already trying to answer a much more strategic question: what will the economy be like in 2 or 3 years? This difference in perspective is crucial. Because the bond market doesn't just react to what's happening now, it reacts to expectations about future growth, future inflation, and future monetary policy. For example, imagine that financial conditions are relatively stable today, but investors begin to perceive signs of a structural slowdown on the horizon. They might start adjusting their portfolios immediately. They can increase demand for safer bonds. They can reduce exposure to higher risk assets. They can anticipate potential future interest rate cuts. These movements begin to appear in bond prices long before any economic slowdown shows up in employment data or GDP growth figures. Historically, this is exactly what has happened in several economic cycles. Before the 2001 recession, many indicators still seemed relatively stable when the bond market began to adjust. Before the 2008 financial crisis, something similar happened. While part of the market still believed the economy was sound, credit markets were already beginning to reflect growing concerns about financial risk. This pattern reveals something important about how markets work. More sophisticated investors don't wait for problems to become clear in economic data. They try to identify early signs that indicate structural changes in the cycle. And when we analyze the current behavior of the bond market, we realize that many institutional investors are already evaluating scenarios of weaker growth for the coming years. We're not talking about an immediate recession, but we are talking about an economic environment that could become progressively more challenging between 2025 and 2026. To understand why this scenario is gaining traction in macroeconomic analyses, we need to look at a structural factor that has become impossible to ignore. That factor is the historical level of global debt. To understand why some institutional investors are beginning to worry about the economic outlook for the coming years, we need to analyze one of the most structural factors of the modern financial system: the global level of indebtedness. In recent decades, the world economy has undergone an intense process of credit expansion. Governments significantly increased their deficits to finance public spending and stimulate growth. Companies took advantage of prolonged periods of extremely low interest rates to issue large amounts of corporate debt. At the same time, consumers in many economies became increasingly dependent on credit to sustain consumption patterns. For a long time, this system worked relatively well. The main reason was the extremely low interest rate environment that dominated much of the period following the 2008 global financial crisis. When the cost of money is very low, carrying debt becomes relatively easy. Companies can refinance loans without much difficulty. Governments can roll over their debts with limited impact on their budgets. Consumers can maintain financing with manageable payments. But there is a fundamental characteristic of debt that is often overlooked during periods of financial stability. Debt is highly sensitive to changes in interest rates. When rates rise significantly, the math starts to change rapidly. Companies that were used to refinancing their debt at very low costs begin to face more expensive conditions in the credit market. This can squeeze their profits and reduce their ability to invest or expand operations. Governments, in turn, begin to allocate a larger portion of their budgets solely to paying interest on public debt. This reduces the scope for expansionary fiscal policies during periods of economic slowdown. And in the case of consumers, higher interest rates can reduce access to credit and increase the cost of financing, such as mortgages, personal loans, and credit cards. The result of this process is usually gradual at the beginning. First, small financial pressures appear in specific sectors. Some companies begin to find it more difficult to refinance debt. Certain segments of the real estate market or consumer credit begin to slow down. But over time, these pressures can spread throughout the economy. This is precisely why many investors are closely watching the relationship between high debt levels and higher interest rate cycles. This combination has historically been one of the factors that amplify economic slowdowns. When we analyze the current scenario, we realize that the world is simultaneously dealing with two important elements: historically high levels of indebtedness, and an environment of significantly higher interest rates than we have seen for much of the last decade. This combination is beginning to raise a relevant question for institutional investors. If the cost of money remains high for long enough, which sectors of the economy might start to feel the pressure first, and perhaps more importantly, how is the credit market reacting to this changing financial environment? To answer this question, we need to look at another key indicator within the bond market: credit spreads. After understanding the impact of high levels of global debt, we need to look at another essential component of the financial system, the corporate credit market. It is in this market that some of the first signs of changing risk perception within the economy often emerge. To understand this, we need to discuss an important concept called the credit spread. Simply put, the credit spread represents the difference between the yield paid by a corporate bond and the yield paid by a government bond considered safe. Government bonds, especially those from developed economies, are generally seen as very low-risk assets. Corporate bonds, on the other hand, carry additional risk because there is always the possibility that a company will face financial difficulties or even be unable to meet its obligations. For this reason, investors typically demand additional compensation to buy corporate bonds. This compensation appears precisely in the spread. When the economy is strong and investors are confident in corporate growth, these spreads tend to remain relatively low. The market assumes that the probability of default is small and therefore accepts lower returns to take on this risk. But when doubts about the future of the economy begin to emerge, this behavior changes. Investors start demanding higher returns to compensate for credit risk. As a result, spreads begin to widen. This movement doesn't happen by chance. It reflects a gradual shift in risk perception within the financial system. Institutional investors are beginning to question whether all companies will be able to weather a more challenging economic environment. They are analyzing corporate balance sheets, leverage levels, and companies' ability to cope with higher financing costs. When these concerns increase, the credit market reacts. Historically, widening credit spreads have been an important indicator that the financial system is becoming more cautious. This doesn't necessarily mean a crisis is imminent, but it does mean investors are adjusting their expectations regarding economic risk. Currently, we are observing signs that this dynamic is beginning to gradually appear in some segments of the credit market. Spreads are not yet at extreme levels, but in certain sectors and risk categories, it is already noticeable that investors are being more selective and demanding higher compensation to take on exposure to corporate debt. This type of behavior often appears in the initial phases of a broader financial adjustment process. And when this occurs at the same time as the yield curve is inverted and debt levels remain high, the most attentive investors begin to analyze the macroeconomic picture with even more caution. But there is another factor that also needs to be considered to fully understand the current state of the global economy. This factor is the impact of recent central bank decisions and monetary policy in recent years. To fully understand the signals the bond market is sending today, we need to look at something that has profoundly shaped the financial system over the past decade: central bank monetary policy. Following the 2008 global financial crisis, many of the world's major economies adopted extremely expansionary policies. The goal was clear: to stabilize the financial system, stimulate economic growth, and avoid a prolonged recession. To achieve this, central banks took two main steps. First, they reduced interest rates to historically low levels. In some cases, interest rates came very close to zero. Second, they implemented massive asset purchase programs, a policy known as quantitative easing. These asset purchases injected enormous amounts of liquidity into the financial system. For many years, this environment created extremely favorable conditions for virtually all financial markets. With the cost of money very low and abundant liquidity, investors were encouraged to take on more risk in pursuit of higher returns. This contributed to a significant expansion in the prices of assets such as stocks, real estate, and even higher risk corporate bonds. Companies also took advantage of this environment to issue large volumes of debt at very low rates. In other words, for much of the last decade, the global financial system operated in an environment of extremely cheap money. But this scenario began to change significantly when inflation once again became a global concern. In recent years, many central banks have been forced to alter their stance and initiate cycles of monetary tightening. This has meant raising interest rates and gradually reducing financial stimulus programs. This shift represents a significant transition in the functioning of the economy. During prolonged periods of low interest rates, certain vulnerabilities can remain hidden. Highly indebted companies can survive because the cost of financing is very low. Entire sectors can grow rapidly based on cheap credit. But when interest rates rise and remain high for a longer period, these vulnerabilities begin to emerge. Some companies are finding it difficult to refinance their debts. Certain business models become less viable when the cost of capital increases. Investors begin to reassess which assets truly offer a good balance between risk and return. This adjustment process usually takes time. The full effects of a tighter monetary policy typically appear in the real economy with a delay. It can often take a year or two before the impacts are fully visible in indicators such as economic growth, corporate investment, and employment. This is precisely why institutional investors carefully observe the cumulative effects of monetary tightening cycles. And when analyzing the current scenario, many begin to consider an important possibility that the full effects of higher interest rates may not yet have fully manifested in the economy. This perception naturally leads to another fundamental question. If the impacts of monetary tightening continue to accumulate over time, when might these effects become more visible across the entire economy? It is at this point that many investors begin to look closely at a specific time frame, a time frame that is starting to gain prominence in various macroeconomic analyses, the period approaching 2026. Now we come to a question that is beginning to appear more frequently in institutional investor analyses. Why are some market participants specifically looking at the period around 2026? To answer this question, we need to look at a structural factor that doesn't always receive the attention it deserves: the corporate debt refinancing schedule. During the years when interest rates were extremely low, especially between 2020 and 2022, many companies took advantage of favorable market conditions to issue large amounts of debt. From a corporate perspective, this decision made perfect sense. The cost of capital was extremely low. In some cases, companies managed to issue bonds at rates that historically would be considered extraordinarily cheap. But there is an important characteristic of debt that cannot be ignored. Debt does not disappear over time. It eventually needs to be refinanced. This means that when these bonds begin to mature, companies need to return to the market to issue new debt to replace the old. And here a potential challenge arises. Financial conditions today are very different from those that existed when much of this debt was issued. Current interest rates are significantly higher. This means that when many of these companies need to refinance their liabilities, they will likely have to do so at much higher costs. This increase in financing costs can have significant consequences. Companies may face greater pressure on their cash flows. Part of their profits may then be allocated solely to interest payments. In some cases, this can limit investments, reduce hiring, or even lead more leveraged companies to face financial difficulties. This process rarely happens suddenly. It tends to happen gradually as different companies enter refinancing cycles over the years. But when a large volume of debt starts to mature within a relatively short period, the effects can become more widespread. And that's precisely one of the reasons why some investors are watching the period between 2025 and 2026 with increasing attention. Furthermore, there is another relevant factor. Governments also face similar pressures when interest rates remain high for extended periods. The larger the stock of public debt, the greater the impact of higher financing rates on government budgets. This can limit the ability of governments to stimulate the economy should a more significant slowdown occur. Therefore, when we combine these elements, high levels of corporate debt, the need for refinancing in a higher interest rate environment, and increasing fiscal pressures, we begin to understand why some institutional investors are cautiously analyzing the mid-decade economic outlook. But understanding the potential risks is only part of the story. The other important part is observing how large investors are actually positioning themselves in the face of these possibilities. And that's exactly what we're going to analyze next. After analyzing all these factors, inverted yield curve, high levels of global debt, changes in monetary policy, and future refinancing pressures, an extremely important question arises. What are large investors doing in this scenario? Because ultimately, one of the most effective ways to understand risk perception in the market is to observe how institutional capital is being allocated. Institutional investors rarely wait for a recession to be officially declared before acting. In fact, the process is usually the exact opposite. They begin adjusting their portfolios long before any economic slowdown clearly appears in the data. This happens because managers of large funds have a central responsibility to protect capital at different stages of the economic cycle. When we analyze some recent movements within the bond and credit markets, we see interesting signs of this adjustment process. One of the most common trends is the increased preference for assets considered to be of higher quality. This includes, for example, long-term sovereign bonds issued by governments with strong fiscal credibility. These assets often act as a kind of safe haven during times of greater economic uncertainty. Another observed trend is a more selective stance regarding corporate credit. Institutional investors are beginning to analyze with even greater rigor which companies have solid balance sheets, manageable debt levels, and the ability to weather periods of slower economic growth. Highly leveraged companies or those dependent on cheap credit tend to face more scrutiny in this type of environment. A gradual increase in the preference for liquidity is also commonly observed. Maintaining a larger portion of portfolios in liquid assets offers the flexibility to react quickly should economic conditions change unexpectedly. This doesn't necessarily mean that large investors are anticipating an imminent crisis. What it usually means is that they are reassessing the risk-return balance within their investment strategies. This shift in posture usually happens quietly and gradually. It doesn't immediately make headlines. But for those who follow capital flows and the behavior of credit markets, these adjustments can reveal important changes in how economic risk is being perceived. And when several of these signals begin to appear at the same time, many experienced investors start to consider a possibility that few like to discuss in advance: the possibility that the economic cycle is approaching a new phase of slowdown. But before drawing any definitive conclusions, we need to reflect on a fundamental lesson that the bond market has taught us repeatedly throughout history. A lesson about how the biggest signs of economic change often emerge quietly, long before they become evident to everyone. After analyzing all these elements, the yield curve, credit spreads, the historical level of global debt, and the cumulative effects of monetary policy, we arrive at a central point that every investor needs to understand. Major economic cycles rarely change suddenly. Before an economic slowdown becomes evident in official data, the financial system typically begins sending gradual signals. These signals first appear in the most sophisticated parts of the market. And historically, one of the first places where these changes tend to emerge is precisely in the bond market. This happens because this market reflects long-term expectations. It brings together decisions from institutional investors who need to assess economic scenarios for many years ahead. When trillions of dollars begin to position themselves more cautiously, there is usually a reason behind it. Throughout this video, we've seen that some of the indicators most closely watched by professional investors are pointing to an environment that could become more challenging in the coming years. The inversion of the yield curve suggests expectations of weaker growth in the future. The behavior of the credit market indicates that investors are beginning to reassess risks. High levels of debt make the financial system more sensitive to higher interest rates, and the refinancing process that will occur over the next few years could create additional pressures for businesses and governments. None of these factors, in isolation, guarantees that a recession will happen, but when several of these elements appear at the same time, they begin to form a picture that deserves attention. Perhaps the scenario that some investors are considering, a more significant slowdown around 2026, will not happen exactly as the market imagines today. The global economy is complex, and there are always unexpected variables. But the history of financial markets shows something important. Ignoring the signals that emerge in the bond market is rarely a smart strategy, because this market often acts as an early warning system for the economic system. It doesn't make predictions aloud, it doesn't appear in dramatic headlines. But through prices, yields, and the behavior of institutional capital, it begins to reflect profound changes in risk perception. And those who learn to observe these signals attentively usually gain something extremely valuable: time to prepare. Therefore, the great lesson here is not to predict exactly when the next recession will happen, The real lesson is to understand how markets work and to recognize when experienced investors begin to shift their positioning. If you want to continue understanding these macroeconomic signals and learn how to interpret what the world's biggest investors are watching right now, subscribe to the channel and follow the upcoming videos. Because often, the movements that truly shape the future of the markets begin silently, long before most people realize it.